Hi, I'm David Scranton, and thank you for watching this video because today we're talking about mutual funds, what they are, how they work, the pros and cons, as well as some alternatives if you're at or near retirement age. And helping me out, of course, with this all-important topic is today's guest, Mark Kanakaris, managing partner at Kanakaris and Associates, located in Woodstock, Georgia. Mark, thanks so much for being here and being a first-time guest on the income generation.
Well, thanks for the invitation. It's great to be here.
So tell me, there's lots of misconceptions about mutual funds, but as you see it, what are some of the major ones that you'd like our viewers to be aware of?
Boy, there's a lot to really answer in that question. First you could just talk about fees. The fees are embedded inside these mutual funds that really are eating away at your profits. I argue to a lot of my clients, until that mutual fund makes sometimes 2 or 3%, you haven't made $1. I mean, it's like running a race with a backpack on your back. And gosh, there's 10,000 mutual funds last I checked that cover any kind of topic that just sounds good to get your money in there. There's, you have the window dressing problem on a quarterly basis.
Sure.
The mutual funds are going to turn around and maybe sell what they think are winners because they don't sound like good holdings and turn back around after the quarter and replace those with some what may be dog stocks, but just the mutual fund manager thinks they're great buys at that time.
Right. So let's break those down. First of all, fees. Sometimes you see these big years in a mutual fund and you think, okay, the mutual fund was up 20%. And people think, well, what's a 1% fee? I mean, it's worth the money if I can make 19 instead of the 20. But how much of an impact does that have if my goal is 10 or 20 years out?
I'd actually say the stretch is depending on what the mutual fund's goal is. If all of a sudden you have a year where you make 19% on something designed to make 10, he's probably overexposed somewhere, and those profits are probably about to walk out the door. I heard Jim Cramer say it a lot, and he would say, if I have really, really good years, there's something wrong.
Yeah. You also find, Mark, that some of the problems with mutual funds is that they don't try to make extra money. They don't try to really outperform the index. What they really try to do is not underperform the index because they're too worried about assets walking out the door if they have a couple bad years in a row.
It's a big trouble when you're managing a mutual fund because you have to keep so much cash just because of that daily turnover of new clients coming in, clients going back. And you're right, they want to maintain that certain range so it seems like they're consistent so people will stay for the long term. And you're right, I think sometimes they give up growth or all of a sudden they have a great growth year because maybe they just caught everything on a perfect storm and then it doesn't happen the next year and even more walks out. I think they may give up profits just to stay in a certain range.
And besides, when most mutual funds get so big, they have over 100 different holdings. I mean, is it even possible to be that much different from just investing in the index itself when you're that large?
I agree with you. You might as well buy the index when you're that large. And how can you really be efficient with that many holdings in there, possibly being traded daily? I mean, we haven't covered turnover costs inside a mutual fund, which is just the trading of the stocks within the fund that the mutual fund holder charges a premium because that's how the company makes their money. So there's all kinds of problems there.
So you talk about the trading. The trading creates another problem because it creates phantom taxes too for fund holders, correct?
Oh my gosh. The worst thing was coming out of the last big market hit, a client of mine who's got a non-qualified trust, which is just the same as anybody's non-qualified account, lost hundreds of thousands of dollars, but he gets hit with a $30,000 capital gain. He paid out taxes on money he never saw.
Yeah.
And the problem from a tax perspective, David, this is when you have non-qualified money in there, you have no control over your tax return. It could bump you a whole tax bracket in a year that you thought you lost money.
Now we have, I'm sure some people watching this video who are reasonably sophisticated, but I'm sure we have many that don't. Can you explain just a little bit more like why that happens? Why can a fund be down this year, but I may get a 1099 saying I owe taxes on capital gains?
Yeah, it's very simple. They sold their winners that they've had for a long time. They sold the winners maybe for cash to pay all the people leaving the fund, but that's all it takes. And even granted, you don't see it in your IRA accounts because you're not responsible for it, but outside of it, it still happens. And it's still a real loss. It may be a suggestion that there's mismanagement within the mutual fund. From the outside looking in, of course.
And you're right, because it's interesting that it's in the bad years, the down years, when people tend to panic and sell, and they essentially force that mutual fund manager's hand to sell. And if they sell things that are legacy assets that are at a gain, well then, guess what? I could be a brand new investor. I may never have seen a gain in the fund, but it doesn't mean that I will not owe a tax this year.
Unbelievable, true.
Yeah. So you mentioned window dressing. Window dressing is something that nobody ever talks about, except for me and you. But so explain what window dressing is and why it's just one of the many ways in which mutual funds and a lack of transparency could really be a negative for investors.
Well, as we all know, if you pull up any prospectus, you're going to see their top 10 holdings. And you want to see top 10 holdings of stocks that you know and heard of that you feel good about.
Right.
The Microsofts, the Apples, the Googles, the Facebooks, the Netflix. But when they don't want to hold those positions because they think some company you never heard of is the next up-and-comer, like a Lee Automotive, next thing you know, they don't want you to see that's a top 10 holding, so they're going to sell it to put back in that Google and maybe pay a premium just to sell out. They have to report it because now it is a top 10 hold by dollar amount, and then they'll turn back around, sell it off to buy back the stock they've been hoping to get a home run on.
Yeah, it's funny because you think about right now, this is the beginning of December 2021, and we're getting a hit now where a lot of the energy stocks are going down in value because the price of oil per barrel is going down. And that's hitting all the newspapers. So now the question becomes, gee, at the end of December of this year, if oil seems to be the stock that's out of trade, that's out of favor, even if you've got, traditional legacy oil companies in the portfolio as a fund manager, you might be tempted to say, let me get those out. Let me window dress those because the media is beating them up, right? And I don't want my people to see that. They'll think I don't know what I'm doing.
Absolutely. I mean, at the end of the day, they get paid by how much money's in the fund.
That's right. That's right.
And if money walks out, that hurts their paycheck and their bottom line. I'm sure there are some good mutual funds out there. The problem is with so many, it would take a career doing nothing but searching through them. And you'd probably always be a year late knowing I should have got this 5 years ago because there's 10,000 of them. Okay. So when you deal with a normal traditional financial guy I like to call the big boxes, they're just going to sell what they're incentivized to sell most of the time because they're W-2 employees and their boss comes in and says, hey, we're selling XYZ mutual fund this week. Call your clients, sell it to them. That's your job. I know they're doing the best of what they have and what they can, but it really does hurt the client more than I think they really realize because they're trusting somebody who's really not capable. Their business model, if you will, is not set up for the client's success. It's set up for theirs. I mean, you remember Goldman Sachs when they interviewed him a few years at the Senate hearing, my responsibility isn't to the people who buy the investments, it's to his shareholders. They were hammering on some derivative that he said in an email he wouldn't own himself. Yeah, but he was selling it to his clients.
Remember the whistleblowers right after the financial crisis with all that stuff. And it's true in every fund. But the biggest benefit I tell people where mutual funds actually are good is for really small investors. If you're just getting started, you can't cost effectively diversify.
Absolutely.
That's when the mutual funds come in. But let's pivot for a minute. Okay. Like I said, we're sitting here in December of 2021. What do you see happening in the financial markets next year for 2022?
Well, everybody hears that we've got to see this supply chain get resupplied. And it's interesting, because where we live, we do have a main train stream. And now I'm seeing these trains that usually have single those big containers. Now they're all doubled up. So they're trying. But if supply chain does not get fixed, inflation will be here. And inflation, it's hitting everybody's bottom dollar. If we can get through supply chain, really get COVID under control, I think things could get back to normal. I think next year could be a growth year. If it was a steady, slow growth year, I would be more happy with that than seeing sporadic growth or over a big shot up in Q1. Christmas will be interesting to see what happens. I think there may be, if there's nothing on the shelf, people will buy what's there just because they want to put something under the tree. So we may get this false sense of security at Christmas that the economy is looking good because Christmas sounds great. Right. But I wouldn't run off and just start saying, okay, it's over, Christmas was great. But it could be a good year.
And then the question becomes all these variants. Right now we're talking about the Omicron variant and all that and what's going to be behind that. And that's going to be a big factor too. Although to some degree, I would have to think that we're even going to get immune to that within 2022 as we get more and more variants come to the surface.
I think we're tired of hearing it.
Yeah, that's true.
I know I am. I'm tired of hearing it. Let's just keep going on. I mean, there's always going to be a variant. The flu's varied every year, but they don't make national headlines because the flu had a new variant this year. There are always going to be variants. I mean, I hate to say it, coronavirus is here to stay. Yeah, that's right. It's disappointing. Yep, we're going to have to live with it for sure. So I'm glad we don't have to talk about coronavirus today. More than that, I'm glad we get to talk about something that's near and dear to most of our viewers' hearts, and that is mutual funds. Mark Kanakaris, thanks so much for being
and a first-time guest here on the Income Generation. It's been
Thanks
great
for having
having
me.
you.
Thank you very much for having me.